Hello, I'm Rajkumar Bhandari here for the presentation on the topic of transfer pricing for the course TACC605 Corporate Accounting on behalf of our Group D. And here are my friends' introduction.
Hi, I am Asmita Pokhrel.
Hi, I am Yojana Paure.
Hi, I am Pooja Jaisi.
Hi, I'm Sivan Skafle.
Now here is the table of contents which includes overall topic of our report. Let's go to the executive summary. Multinational corporations MNCs often use transfer pricing to shift profits to low-tax countries, reducing their overall tax payments. Apple Incorporation has been known to employ such strategies, leading to significant tax disputes. To address this, a proposal suggests taxing MNCs based on their global activities, aiming to make a tax systems fairer and more transparent. However, implementing their faces challenges such as international coordination and resistance from tax havens. On this topic, Asmita will present. Thank you.
For the presentation. Now I will present about the transfer pricing. Transfer pricing is about setting prices for transactions between related companies in different countries. These transactions don't follow normal market rules, arm's length principle. Careful review is needed to ensure fairness and compliance with rules. It affects tax reporting and financial record across the countries. Transactions are controlled by the same company, so they don't need extra sanctuary. Further will explain by Yojana. Thank you.
Thank you, Asmita. Now I am going to contrast in arm's length price, the price that unrelated companies will agree to do in a normal commercial deal. These principles, if related companies set different terms than independent companies, their profit can be adjusted for tax purposes. Goals ensures fair taxation by treating related companies like independent ones for financial transactions. Now Pooja will explain process in determining arm's length principle.
Thank you, Yojana. Now, here is a simplified version of how the arm's length principle is applied. First one is check transactions. It verifies if related party transaction follows arm's length standard. And second one is use pricing methods, applying proper transfer pricing method to determine the right value. And third one is follow OECD guidelines, use guidelines for areas like intangibles, intra-group services, and business restructuring. And the key factor considers are relationships, that is identify the financial or commercial links like between parties. Accurate transactions helps to analyze the true nature of the transaction. And the next one is losses, which helps to adjust for unusual losses. Government rules helps for account for local government policies. And the next one is customs data, use custom values to across the check pricing. Local benefits, consider saving from the local or market conditions. And next one is workforce values, factor in the worth for the local workforce. Groups, that includes benefits from working as a multinational groups. More will be discussed by the Sivans.
Thank you, Pooja. Now I am discuss about transfer pricing method and how transfer pricing methods are selected. The tax authority pick the method the best suits the case. The multiple method may be used if needed. Selection is based on first strength and weakness of the methods and nature of transaction using a functional analysis. And third is our ability of comparable data, how similar the transaction is other compatibility. And the number four is no single method work for every situation. This is the list of the transfer pricing method. First is comparable uncontrolled price CUPU methods, and second is resale price method, and third is cost plus method, and fourth is transactional net margin methods and transactional profit split method. There are two. And now we discuss the main assessment. So here will Raj present the questions number one. Thank you so much.
Multinational corporations MNCs often use transfer pricing strategies to allocate profits across different countries, aiming to reduce their overall tax liabilities. The main methods include: number one is mispricing transactions, setting artificial prices for goods and services exchanged between subsidiaries in different countries to shift profits to low tax jurisdictions. Second one is royalty arrangement, charging high royalties to to subsidiaries in higher tax countries for the use of intellectual property owned by subsidiaries in low tax jurisdictions. And the third one is intercompany borrowings. Arranging loans between subsidiaries with inflated interest rates to reduce taxable profits in higher tax countries. And the next one is allocation of intangible assets. Assigning ownership of intangible assets such as patents or trademark to subsidiaries in low tax countries to allocate a significant portion of profit to these jurisdictions. These practices are part of a broader strategy known as base erosion and profit shifting (BEPS), when companies exploit gaps and mismatches in tax rules to shift profits to low or no tax locations, resulting in the erosion of the tax base in higher tax jurisdictions. While these strategies may be legal, they often face scrutiny from the tax authorities worldwide. International efforts, such as those led by the Organizations for Economic Cooperation and Development (OECD), aims to address BEPS and promote fair tax practice. And the next question too will be briefly discussed by Asmita. Thank you.
Now I will discuss about case study 1 related to Apple Inc. subsidiaries and case 2 related to Australian Taxation Office challenges related to manipulating transfer prices. Case 1 Apple Inc. and Ireland talking about background. Apple used subsidiaries in Ireland to challenge global sales profit, benefiting from Ireland's favorable tax policies. European Commission's ruling 2016. The Commission concluded that Ireland's tax arrangement with Apple were illegal, ordering Apple to pay 13 billion in back taxes. In the context of European Court of Justice decision 2024, in September 2024, the court upheld the Commission's ruling confirming that Apple owned over $14 billion in back taxes to Ireland. Case 2 Glencore and Australia. The Australian Taxation Office (ATO) challenged Glencore for manipulating transfer prices to shift profit to low jurisdiction. Federal Court's decision 2019. The court ruled in favor of Glencore, stating that the company's transfer pricing arrangements were consistent with the arm's length principle. ATO's appeal 2020. The ATO appealed the decision, but the full federal court dismissed the appeal, reinforcing the original ruling. Apple case highlights the European Union's commitment to enforcing fair tax prices and preventing illegal state aid. Glencore case demonstrates the complexities of transfer pricing, disputing the importance of the arm's length principle in international taxation. These cases underscore the global efforts to ensure tax fairness and challenges in regulating multinational corporations' tax strategy. Thank you. Now Yojana will discuss this further.
Thanks. Here I will explain about rationale behind consolidated taxation for multinational corporations. Implementing consolidated taxation for multinational corporations (MNCs) involves assessing the overall economic activities of the entire corporate group rather than treating each subsidiary as a separate entity. This approach offers several significant benefits: parity of tax treatment, that ensures that all subsidiaries with a corporate group are taxed uniformly, preventing disparities that could arise from varying tax rates across different jurisdictions, and then determines real taxable profit, provides a more accurate assessment of taxable profits by considering the combined financial performance of the entire group, leading to fairer tax obligation, and then reduction of artificial price distortion, minimizes the needs for intercompany pricing adjustments, which can be manipulated to shift profit artificially, thereby promoting more transparent and equitable pricing practices. After that, minimization of double taxation. Reduce the taxing the same income multiple times across different jurisdictions, ensuring that profits are taxed only once, thereby lowering the overall tax burden. Ensures proper attribution of income. Allocates income to the jurisdiction where economic activity genuinely occur, aligning tax obligation with the actual creation of value and enhancing the fairness of the tax system. By adopting consolidated taxation, MNCs can achieve a more equitable and efficient tax framework that reflects their global economic activities. Now, Pooja will explain potential challenges of taxation policies. Thank you.
Thank you, Yojana. Now I'll discuss about the potential challenges in adapting group level taxation policies. Implementing taxation for multinational corporations involves assessing the entire corporate group's economic activities rather than treating subsidies separately. This approach offers several benefits like uniform tax treatment, which ensures consistent taxation across all subsidiaries, preventing disparities due to varying tax rates in different countries. And another one is accurate profit assessment, which helps to provide clear pictures of taxable profits by considering the combined financial performance of the group. And the next one is reduced tax avoidance, which helps to limit the ability to manipulate intercompany pricing, promoting their fairer tax practice. And another one is minimize double taxation, which helps to decrease the likelihood of taxing the same income multiple times across different jurisdictions. Proper income attributions, which aligns the tax obligation with the actual creation of values, ensuring income is taxed where it is earned. However, implementing this system faces challenges like international coordinations. Aligning tax policies across countries is complex as each nation has its own tax laws and priorities. Achieving global consensus requires extensive negotiation and compromises. And another challenge is complex profit allocations. Determining fair profit distribution among subsidiaries is intricate and requires detailed analysis. Resistance from tax havens. Countries whose favorable tax regimes may oppose consolidated taxations as it could reduce their attractiveness to MNCs and impact their economics. And another one is enforcement challenges. Helps to monitor compliance among MNCs demands significant resources and expertise. Tax authorities need advanced systems and skilled personnel to track complex international transactions and prevent tax avoidance. And another one is addressing these challenges requires coordinated international efforts, clear legal frameworks, and robust enforcement mechanisms to ensure the effective implementation of consolidated tax legislation. Thank you. Now conclusion will be discussed by Sivans.
Thank you so much, guys, for your lovely presentation. For the final part, I am here for the conclusion and recommendation. Now, there are some of the key points here I'm going to tell in the conclusion. Transfer pricing strategy. Manipulate that intercompany pricing to shift profit to low tax jurisdiction, undermining fair tax system. And second is consolidated group taxation. Taxing at a consolidated group level, focus on the group global activity, improving the transparency and reducing the manipulation. And third, we have the implementation challenge, addressing international coordination complexity and vegetation for tax haven is essential for effective information and fair global taxation. Now we have lastly we have recommendation and tax authority. So recommendation and tax authority has to effective combat profit shifting and ensures fair taxation. Tax authorities should consider the following measures. The implement country by country reporting, require multinational corporation to disclose financial and tax information for such jurisdiction they operate in, enhancing the transparency and enabling the better assessment of tax liabilities. And second, we have the strength transfer pricing rules. enforce strikers guidelines to ensure that in intercompany transactions reflect to market value, preventing profit shifting through manipulating price. Enhance international collaboration, work with other countries to harmonize the tax policies and share information, reducing opportunity for tax avoidance through mismatched regulation. Promote tax treaty reforms, update and reform tax treaties to close loopholes that allow profit shifting, ensuring that profit are taxed and public disclosed informations. And now it encourage and mandate the public disbursement and the financial data by the corporation, increasing accountability. Now we have enhanced transparency in the trans havens. Now we have imposing penalty for non-compliance, and we have improve audit capability. Now let's discuss the improve audit capability. Invest in training and resources to enhance the ability of tax authorities to conduct thorough audit of multinational corporation. The leverage technology and data analytics, utilize the advanced technology and data analytics to detect and prevent tax evasion, improving the efficiency of effectiveness of tax information. Now we have the last the reduce process in their taxation and discourage aggressive tax planning by multinational corporations. Part, hello, this is the now last part. This slide is reference of our work. Our presentation has finished now, so this is the we from where we put the references. Our team has doing so much work. Thank you so much for our guys. Thank you so much for listening to our presentation, ma'am. Thank you, professor. Have a great day. Bye.